welcome everybody to another Market Insight. Joining us today is Dave Muscatello and Mehernosh engineer from Fidelity Institutional Asset Management, as well as Chris Ahrens, who is one of our analysts here at Gatewood Wealth Solutions. Mehernosh engineer is a vice president of Capital Market Strategy Group at Fidelity Institutional Asset Management, Fidelity Investments Distribution. Prior to joining Fidelity in 2014, Mr. Engineer worked as a senior macro credit and portfolio strategist at BNP Paribas. Previously held the research and portfolio advisor role at Morgan Stanley, working with the institutional clients across Europe. Mr. Engineer earned his Bachelor's of Technology degree in Metallurgical Engineering from the Indian Institute of Technology in Bombay, his Master's of Science degree in Material Science and Engineering from the University of Delaware, and his Master's of Science degree in Financial Engineering from the University of Michigan. Wow, Mehernosh, your last name is fitting. Dave is a regional director with Fidelity. Dave, I believe you were actually at our last live event in January of 2020. I don't think the listeners are going to be as pleased with you this time since you're not buying the wine. Dave is a great resource for GWS partners, and he partners with us. So our mission is to help clients become and remain financially self-reliant, and he's a critical partner in that. And many know Chris and are familiar with his deep knowledge on individual stocks. He's also done a few of the 3x3s where we give a brief update. So if you're not subscribed, please click below and subscribe so that you always catch those. And Chris is likely to host additional market insights as my wife and I are expecting our second child any day now. And John has escaped the cold weather. That's why he's not here today. He did not want to participate in the 50 degrees in St. Louis, and he is down in Miami. So John, we miss you, and I don't think you miss us that much. But I'll turn it over to Mehernosh.
Good morning, everyone. And as we get into the second month of 2021, it's worth looking at 2020 first. And as we went through 2020, the key focus for us was all about managing the two underlying risks. And what I mean by that is essentially managing the healthcare virus side of the risk. And then secondly, in the second half of the year, it was all about the political risk. Sitting in 2021, the focus is the exact opposite. It's all about the reopening of global economies as a consequence of the vaccination process. And secondly, the reflation trade, which is a consequence of the monetary and fiscal stimulus that the governments are doing across the globe. So let's first address the virus vaccination side of things, and then we look at fiscal policy. So sitting today, firstly, in the U.S., we know that the Pfizer and the Moderna vaccines were both approved in early and middle of December, and now it's literally 2 months since they've been available. And as we sit today, about 63 million doses have been distributed. If you look at the number of people who've taken one dose, it's about 32 million. If you look at the number of people who completed the vaccination process, it's getting close to 10 million in a sense. So sitting today, still awaiting the Johnson & Johnson vaccine, which could be approved any day today. Our estimate is that about 125 to 150 million people will get vaccinated by the middle of this year. Now, having said that, let's also take a look at the global picture. So as you can see, the AstraZeneca vaccine, or also called the Oxford vaccine, that's been approved in Europe. It's being widely distributed in Europe, in India, in Latin America, and even in the Middle East. 2 weeks ago, we had the Novavax vaccine, which was also approved, very high efficacy rate. And then China and Russia have their own versions of the vaccine, which are also being distributed in Europe, in India, as well as in Latin America. So the bottom line being that the world is getting vaccinated today, and we should look towards a much better economic investment scenario going forward. Now, let's shift gears and talk a little bit about the global economic scenario. So about 6 months ago, when we were having this discussion, we noticed that every single economy was very much in recession, in contraction phase, struggling with the virus side of things. Sitting today with the vaccination process, with the fiscal and monetary stimulus, we note that every single major global economy is now in what we call as early or mid-cycle, more so in the recovery phase. And sitting today, the global economy is definitely being led by the Asia-Pacific region, primarily China, followed by the US, and then you have the Eurozone, UK, and a few other major economies. But let's focus a little bit on the US, especially with the new administration. So last year, the US economy actually shrank by 3.5 percentage points. Sitting today, not accounting for the stimulus packages, the infrastructure packages, which may come during the year, our estimate is that the economy will grow by about 3.6%. So literally over 2020 and 2021 will be almost flat and at the same level we were at the end of 2019.
Quick question.
Having said that, let's look at...
Quick question on this slide that we're looking at, and I love the slide, is given that we did have a contraction in GDP and we're looking at this and it's showing a mid-cycle, would it be fair to think of it a little bit as more of a earlier on in the cycle, considering that some of that correction has kind of cleared some of the previous investments that were not working, or would you guys still say that this is kind of that mid-cycle?
I would definitely say that the virus crisis did bring about a paradigm shift. So we know that the work from home environment is going to be a permanent feature. And what I mean by that is not that we are going to be confined to our homes for the rest of our lives, but a lot of people will now start working at least a day, if not 2 or 3 from home. That reduces the commute factor. It increases the quality of family life. So I believe certain changes have come about, and therefore it will also impact certain business models. So we at Fidelity definitely know that our business travel will be much lower. We'll be doing a lot more meetings via Zoom or WebEx, so all these telecommute kind of options which have now come about as a consequence of technology.
Perfect. Thank you.
Okay, so let's expand on the U.S. fiscal side of things. So last summer, during the pandemic, we passed 2 fiscal stimulus packages, the CARES Act, the first version, and the second version, both of them totally accounting for close to about $3 trillion. And towards the end of the year, we passed another $900 billion fiscal stimulus package, which sent out checks of $600 per person for anyone making less than $75,000 per head. Now, sitting today, we are very close to another very big fiscal stimulus package being passed. And sitting today, we would say the minimum size of that is going to be at least $1.1 trillion. And if the politicians can get everything passed which has been suggested, it could be as high as $1.9 trillion. So a few key features worth looking at from a consumer perspective. So firstly, yes, the stimulus checks will be about $1,400 for every individual up to $75,000 or household income, I believe, up to $150,000. And then it gets phased out up to $100,000 per person or $200,000 per couple. Now, that is just the first thing. Then they've also increased the unemployment benefits from $300 per week to $400 per week. And then within the package, we are anticipating a few more fiscal giveaways in a sense. So they're looking at what we call as child credit. So any child below the age of 6 will receive a credit of about $300 per month or $3,600 per year. And if the child is between the ages of 6 and 17, that will be reduced to $250 per month or $3,000 per year. Yes, this will be income tested in a sense, so not everyone is going to receive it from that perspective. Also, they're looking at providing a little bit of boost to the housing market. So they're looking to provide what they call as housing credit. So $15,000 of housing credit for anyone who's not bought a first home during the last 3 years. So essentially, the government makes the down payment on your behalf, and that facilitates movement out of renting into home ownership in a sense. And the last thing, which is a little bit ambiguous at this point in time, is about reducing the student loan burden. So firstly, I would say there are 43 million students who are burdened with about $1.7 trillion in debt, and that's curtailing a lot of movement up in society. So they're looking to cut back, or I should say they're looking to forgive student loans anywhere between $10,000 per person up to $50,000 per person. So all of this fiscal stimulus essentially means that it'll lead to job creation, it'll lead to income growth, it'll lead to economic growth, as well as earnings growth. But it also comes with certain consequences in a sense. And what I mean by that is the other side of the equation, which is the budget deficit. So last year, we ran a budget deficit of about $3.7 trillion. Now, in the context of a $21 trillion economy, that's about 17-18%. So fairly large, quite unprecedented. And let me put some context to it. So during the global financial crisis, which was 2009-2010, we ran a budget deficit of half of that at about 9 to 9.5%. The only time we've run a budget deficit more than 20% was actually during World War II. So even during World War I, it was curtailed at about 10 to 15%. Now, this is also not a one-year phenomenon. So last year, we ran a budget deficit of $3.7 trillion. This year, the forecast is that it'll be somewhere again between $3.5 and $4 trillion in a sense. So all of this means a lot of fiscal stimulus, a very large budget deficit. And what does a budget deficit actually mean? It essentially means that the U.S. Treasury is spending more than what it is taking in. And it does that by issuing new debt, which is U.S. Treasury debt. That debt is bought and monetized by the central bank, which is the Federal Reserve. So the Federal Reserve buys the debt, issues newly printed dollars to the U.S. Treasury. The U.S. Treasury goes and spends that in the domestic economy, thereby increasing the supply of dollars, which leads to a weaker currency, or what we call as technical devaluation or debasement of the currency. And what I'm showing you on the screen is the 50-year chart of what we call as the U.S. dollar index. So the U.S. dollar versus a basket of currencies. And it goes through periods of strength and it goes through periods of weakness. And what I want you to focus on is on the middle part of the chart from 2001 to 2008. So we had very similar macroeconomic conditions at that point in time to what we see today. So we were just coming out of the dot-com recession. 9/11 had just happened. After that, we went to war in Afghanistan. The war in Afghanistan got extended into the war in Iraq. And as we know, wars meant a lot of spending, very big budget deficits. And during that period, on average, the dollar went down about 4.5% every year, but cumulatively, it was a significant devaluation of about 30-odd%. And sitting today, we are looking at very similar conditions. So very few investors have actually realized that the dollar weakened last year by about 9.5%, and we are looking at something similar again this year.
Nash,
So
one of the things that we have been talking on our Market Insights call for quite some time is just some inflation risk.
Yes.
Whenever I remember in 2005, 2006, whenever gas was at almost $4 a barrel, and we were really experiencing inflation from that. Are we expecting, or is Fidelity expecting to see a return of inflation?
Absolutely. So weakening a currency, printing money always leads to inflation. And even the central banks are telling us that we should see a slight increase in inflation. And they've said, so the central bank itself, the Federal Reserve, has changed its mandate from curtailing inflation below 2% to saying we will now tolerate inflation about 2%. Now, what that means is, will they tolerate it up to 2.5%, 3%, 4%? That is yet to be seen. Secondly, what is the time period that they will tolerate it up to? And history tells us that inflation up to 4% is not really a concern. So I would say, based on my experience in the markets, that if we see inflation for, say, 4% for probably 2 quarters, that will still be considered as okay. But if we pass 4%, or if we go longer than that, then it starts becoming a little bit of a concern in a sense.
Hey, Nash, whenever we're looking back historically on those inflation rates where you're saying 4%, the economy seems to be able to manage that. What do we as investors think about whenever there are bonds that are not yielding anything close to that yield, and we would see inflation? So, I don't think that the interest rate is going to skyrocket by any means and have an inflation premium. But how do we think about that in such a low rate environment when we're saying historically we could do 4%?
So first of all, we don't expect bond rates to follow inflation. So we expect the Federal Reserve to do what we call as yield curve control, which is to step in and control rates in a sense. So yes, inflation will be higher than rates. And therefore, what we've been recommending to clients is 2 things. 1, decrease your bond portfolio marginally, go into interest rate sensitive equities. Secondly, within the bond portfolio, you want to decrease your interest rate sensitivity, which is your U.S. Treasuries, U.S. mortgages, and get into more credit sensitive sectors. So that would be investment grade bonds, and then your high yield satellites like real estate, emerging market debt, floating rate notes, high yield bonds, things of that nature. So marginal shifts, expecting this inflation to increase in the months to come in a sense.
Thank you.
Okay, so the last part about the weaker dollar and the question coming back to who benefits from a weaker dollar. And what I'm showing on the slide is what we call as a talent chart. And essentially, it ranks all the assets that are investable today for most investors from top to bottom for every single year. But what I want you to do is to focus on the period between 2003 and 2007 when the dollar actually weakened. And what you see is that emerging markets were the biggest beneficiaries. They were the best performing asset class for 5 consecutive years. You literally doubled your money. And below that is what we call as international developed markets, which essentially is Europe, Japan, Australia, Canada, Japan put together. So those would be the 2 big asset classes outside the US, which would be beneficiaries of the weaker dollar. But if we look below that, and especially within the domestic economy, what we see is that the key beneficiaries are small capitalization companies, mid-cap or middle capitalization companies in a sense. And essentially, summing all this up, what we would say is that a weaker dollar favors cyclical assets. And those cyclical assets can be outside the US or within the US. So within your portfolio, you definitely want to increase what we call as cyclicality sitting today. So just coming back to the portfolio, and then we'll open it up for Q&A. So sitting today, as I mentioned, we are going for what we call as a tilted barbell approach, which essentially means a gradual increase in the equity allocation, slight increase in the fixed income allocation. And firstly, on the fixed income side, to reiterate, increase the credit sensitivity, decrease the interest rate sensitivity. And going over to the equity side, you want to increase cyclicality by going into small caps, mid caps, and then if you're looking from a sector perspective, that would be industrials, materials, financials, energy, and consumer discretion. So everything that was hurt very significantly last year, especially in the first half of last year, and as we start reopening the economy, those sectors will start coming back. So very simplistically, think about airlines, hotels, casinos, cruise lines, restaurants, retailers to a smaller extent, and all the ancillary businesses around it. And definitely on the equity side, increase the allocation to international, more so emerging markets. So, Aaron, let me stop there and let me open it up for Q&A.
Absolutely. Really appreciate everything here, Nosh. One of the things that we have been talking about, and if you were looking at our investment theme, we talk about inflation risks being high. And we are favoring technology. It looked like that's one of the items that you guys do have. We have had some industrials and materials, but we've recently replaced them with commodities, seeing that inflation theme. And we have an emphasis on small cap and mid cap, and have moved into a little bit of that value rotation that we've seen in the market. We are neutral on emerging markets, and Fidelity actually has the money for the emerging markets in many of our portfolios. So I'd love to kind of get into that fund. But I think one difference from what you've gone over is we really have kept our international developed area neutral to underweight because we just see a lot of problems within the Eurozone as well as Japan. What are your thoughts on those specific regions, despite in an agreement that the dollar is probably in a downward trend?
So very good question, Aaron. And the first thing I would say is that we at Fidelity, we don't invest in countries, we invest in companies. And let me expand on that a little bit. So let me show you a very interesting chart that will illustrate what we are actually looking to do in a sense. So as you correctly mentioned, if you look at Japan or if you look at Europe, demographically, they are a disaster. So what we plotted on the screen is the prospective growth of countries based on their underlying populations. So as you can see, Japan is towards the left corner and the rest of Europe is towards the left corner. The US within the developed world is the fastest growing economy in a sense. So from that perspective, yes, you may want to be underweight. Having said that, one has to distinguish and break up these markets into two parts. So sectors which are aligned with demographics and sectors which are aligned with exports to the emerging markets. So what we do within our portfolios is that we are actually underweight those sectors. So those would be banking, insurance, retail, telecommunications, utilities, everything tied to demographics, which is not going to show any growth. If at all, it's actually continuing to decrease. And where we see opportunities are the key exporters into emerging markets. So healthcare companies, consumer staples, certain industrials like Airbus, all the German automakers, and now you're starting to see renewable energy exports coming out of Europe. So it's all about picking companies rather than countries in a sense. So if you look at it from a country perspective, yes, definitely you want to be underweight Japan and Europe. But if you look at the broader, big global multinationals, there are a lot of excellent companies within Europe even today, as well as in Japan. And Japan actually is one of the leaders in automation and robotics sitting today. If you look at an iPhone, there are a lot of innovative components going into an iPhone which are actually developed out of Japan. So it's all about the underlying stock picking rather than country picking for us at Fidelity.
Perfect. And so being that there are underlying companies that you want to look at and the idea that the dollar would be decreasing, what companies do you think here would benefit from maybe expanding their export market if their goods that they're producing here are cheaper whenever you look at the currency exchange?
So the one thing that most people miss is that a weaker dollar actually increases tourism very significantly. So this time around, yes, it'll be a slow process, but we do expect that in the second half, tourism to pick up quite significantly. And who benefits again from tourism? It's airlines, hotels, your Disney parks, things of that nature, restaurants, retailers. So again, that cyclical theme in the mid-cap, small-cap space will be a big beneficiary. On the other hand, a weaker dollar also increases consumption in emerging markets. So then you have to ask the question, who benefits from it? And therefore, we've been buying European healthcare, consumer staples, some of the top names like Louis Vuitton in the fashion space, things of that nature. And similar companies, even in the US, should be doing quite well on the back of it.
Hey, Nosh, on that note, two different questions. One, are you concerned at all about maybe a vaccine rollout and how you see that being more choppy in the emerging market space in the months ahead and what that kind of looks for the reopening of economies? And then my next question, more on the US side, is all of the talk this year has been tech stocks are overheated, growth is overheated. There's been a lot of move to value, a lot of outflows from QQQ in the tech space. But as earnings come in, it looks like there's some really good earnings there. So just kind of how do you think about the whole growth over value talk in general for the year?
Okay, so could you repeat the first question? The second question I got growth versus value, but the first one, I wasn't sure what you wanted me to comment on.
Just more, are you concerned about a vaccine rollout? Maybe it happens much slower than we anticipate in the emerging market space. Do you think that will impact the outlook?
Okay. It's actually the opposite. So I would say the vaccine rollout, if you look at in China, India, it's actually slightly above target, and things are coming back to normalcy. So I wouldn't be surprised that in 2 quarters' time, international travel should start opening up quite vigorously from that perspective. So to me, the vaccination in the emerging markets is not really a risk, because we've already seen over the last quarter, Asia Pacific is actually leading the global economy in terms of growth from that perspective. In coming back to your second question, that is a very good question about growth versus value. So over the last decade, and I would actually say over the last 3 decades, growth has done very well. And a lot of investors come to me and say, now that we are seeing a cyclical recovery, should I be selling all my growth and going to value? And that would be the biggest mistake you would be making. And most investors come to that question because they believe that growth is nothing but software and social media. That is not growth to us. Growth to us is disruptive technologies and innovations. And before I get into what are the innovations that we are looking at, it's worth stressing that innovation is independent of politics. So whether you have red, blue, or purple in Washington, D.C., innovation will continue to take place. Secondly, innovation is independent of where we are in the business cycle. And last year was an excellent example. So despite the shutdown, we saw a lot of innovations still continuing to take place. So keep these 2 big factors in mind. Now, sitting today, what are the innovations that we're looking at? So over the last 2 weeks, we had earnings from Microsoft as well as Amazon, and both the earnings were great, but the key comment that I picked up on is the guidance, which is to say that corporates continue to increase their information technology capital expenditure spend on cloud computing. So that is just the first stage of setting up the infrastructure. Followed by that, we'll see big data analytics, machine learning, artificial intelligence. So that is something which will continue to play out at least for the next half decade. Now, sitting today, we are also starting to see global 5G infrastructure being installed. So that itself is a 3 to 5 year play, followed by 2 very big applications, which would be autonomous or driverless cars, and secondly, it would be telemedicine. And most investors think the industrial space is old, boring. That to us is actually a very exciting space today. So we're starting to see more and more electric vehicle producers coming into the market. So broad-based adoption of electric vehicles globally. On the back of that, there is a big stress on renewable energy. So solar, wind, on the side, I would say nuclear, natural gas, also investments taking place, but more so with a focus on clean technology, also battery storage technology. And the last thing I would mention on the industrial side would be increasing amount of automation, robotics, not only in manufacturing, but over the next half decade, we'll see a lot more robotics also entering the household in terms of helping us with a lot of day-to-day activities also. And finally, the chart in the right-hand bottom corner, that would be about biotechnology. So with the cost of mapping the human genome coming down, that's facilitating a lot of good, cost-effective research into new targeted therapies, into looking at new diseases, rare diseases, and even improving on existing therapy. So all of this to us is innovation, and we continue to invest in that in a sense. Having said that, as I mentioned, yes, there is a big cyclical uptick in the economy, and you want to capture that, and you want to do it via mid-cap, small-cap funds which are exposed to cyclical sectors like industrials, materials, energy, financials, consumer discretionary.
You know, Nash, one of the things that we have talked about here, and I mentioned that we see inflation risk being high, but we're not saying certain, is because technology and innovation is necessarily deflationary, that you're able to produce more with the same amount, if not less amount. So that's a theme that, or it goes against one of our themes as a possibility. And then with still likely a declining dollar relative to other currencies, we see this automation play over the next decade, and some needs to diversify supply chains. It's one of the reasons that we do favor the U.S. over some areas, because we think that they could lead here in that automation and really changing a lot of the older antiquated industrial models to a more modern program. And I just wanted to get kind of your thoughts on those ideas, and you know, whether you guys think that value play, that Fama French model that has said historically worked and has historically not worked, whether it still makes sense to keep that overweight the growth, which I think is what you were saying.
So I would say for all long-term investors, you want to keep that marginal overweight to growth. Having said that, yes, you want to play the cyclical element as well as the inflation element. So I've talked about the cyclical element. On the inflation element, you're absolutely right. You want to increase your exposure to commodities, and Fidelity has an excellent commodity equity fund, so we don't invest in commodity futures or options or anything of that sort, nothing exotic, very simple investing in copper miners, gold miners, energy production companies, agriculture-based companies which provide fertilizers, phosphates, things of that nature. And that's actually a global fund, primarily all large capitalization companies, so all well-known companies to most investors in a sense. So I would say that is something also we are recommending to clients to increase it, expecting commodity increases over the coming quarters.
One of the things that we talk about here as a pillar for us is to have enabling and integrated technology within the wealth management world, because really we feel that whatever company it is over the next 5 to 10 years, every company is essentially going to be a technology company, and they're just going to be serving the market with technology, with whatever product that they have. What are your thoughts on that comment?
Absolutely. Totally agree with that statement. So the way we look at it is that the world is getting digitized, and you need to have an online presence. You need to have an e-commerce presence, more and more marketing, finding your consumers, who are your consumers, how are they consuming your product. So all that underlying all of that is technology. So definitely that is a very big theme that we are looking at across industry. And that could be in healthcare, could be in retail, could be in utilities, could be in telecommunications. So all those sectors are becoming bigger and bigger consumers of technology, and cloud computing, setting up the infrastructure is the first stage. That'll be followed by collecting the data, what we call as big data analytics, and then you can actually make use of that data using what we call as machine learning and artificial intelligence.
One of the asset classes that you had mentioned and historically has been a great inflation hedge is real estate. And then when we're looking out at the world with as much change as happening, the work from home phenomena, where people, as you had mentioned, are going to be working 1, 2, maybe 3 days, and even some going full time. And we see problems in New York and San Francisco, some of the big metropolitan areas, as people are no longer going into work. How should we think about real estate, considering some of these headwinds because of the change of the habits and the way that people are approaching work now?
So excellent question. So this work from home environment, the first thing I would say is not temporary. It's a paradigm shift. And it's created some relative winners and losers. So the losers, very easy to identify: residential and commercial real estate in big urban areas. So definitely New York, San Francisco, Chicago, LA, all of those big cities. Yes, we've seen the migration out of centrally located areas into more suburbia. Now, what that also means is, as we've said, more people will be working remotely, more e-commerce will be taking place. So now there are specialized companies called data server farms which are coming about. And all that they do is house data servers in the middle of nowhere, in controlled temperatures, constant electricity provision, earthquake assurance, things of that nature. And these are specialized real estate companies. So that's a big opportunity that is coming about. Most of your clients would have heard about a company called American Tower. All that they do is put up 4G, 5G stations, which allows for telecommunication. And they are nothing but toll keepers on the digital highway in a sense. And lastly, don't forget demographics. So aging demographics means hospitals, nursing homes, assisted living. They are seeing a lot of demand also. So real estate today, as we always say, firstly, it's all about location, 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 and then finding the underlying theme for it. And the last point I would say is that Amazon is also looking to set up 1,000 warehouses across the U.S. So that's another part of real estate which is seeing very big demand. And as we know with Amazon, they never buy anything, they always lease it. So that's another opportunity for investors to be getting into.
Hey, Nosh, you mentioned 5G. What are your thoughts on just kind of the impacts of 5G, the rollout? I think it's talked about a lot, but I think there's a lot of curiosity around there.
That was absolutely going to be my question. I don't think people really have an appreciation on how much 4G changed the world. Because you wouldn't have Uber and Lyft and many of the other things that we take advantage of now. Shipt is a company that is owned by Target for the grocery delivery. So I will just second that question on what does 5G mean to us in the future?
Okay, so I've just brought up the chart of the usages of 5G and what's the difference. Let's first start with what's the difference between 4G and 5G. And two key differences. One is speed. The second one is energy consumption. And 5G is about, I would say, 25 to 30 times faster than 4G. And it uses significantly lower amount of energy. And let me give you a very good example of that. So about 2 years ago, we were trying to do testing of autonomous driving in Scottsdale, Arizona. And Scottsdale, Arizona is a very good test city to do it because it's very much built on the same way as Manhattan, which is basically rectangles throughout the city. So very easy for cars to navigate. But what they found is that we were still getting into accidents. And the accidents were taking place because there was a lag between the signal being sent from the car to the base station and receiving the instructions back from the base station. In technical terms, basically, the feedback loop or the lag was quite significant. And when we talk about this lag, we are talking about microseconds. So with 5G, we brought that lag down now to nanoseconds in a sense. And therefore, 5G infrastructure is critical for autonomous driving to come about. So that's one very big application. The other big application is going to be telemedicine. So today, yes, you can do a phone call, a video call with your doctor for very easy diagnostic things of that nature. But going forward, if you actually want to do remote surgeries, if you want to do robotic remote surgeries, and believe me, all of this is already being planned. There's a company which is literally 10 minutes away from where I live called Intuitive Surgical. They're at the forefront of all of this. So once that infrastructure comes about, we're looking at some of these things. Lastly, I would say a very common application is going to be drone deliveries, which also need precise mapping down to, I would say, a 1 foot by 1 foot area to put the package at the right point. So all of those things require 5G services in a sense. And then there will be other applications which will come on the back of it. So most investors are underestimating the impact of 5G. To us, it's going to be the third version of the internet and possibly the most powerful game-changing version of the internet, which we are going to see over the next decade.
And one of the funds that we hold is the Fidelity. What is it? Emerging Asia. What is it, Chris?
Fidelity Emerging Asia.
Fidelity Emerging Asia, and I seen on one of your other slides you guys were talking about focused emerging markets. What's the difference between those? And Dave, maybe you need to take that question and let us just know what the difference is.
Yes.
Make some
okay.
comments.
So let me go back to this slide. So the difference, when we say emerging markets, basically you're looking at all the emerging markets primarily in the Southeast Asia region, so dominated by China, India, and then the 15 to 17 countries in the Asia Pacific region, excluding Japan, which is a developed market. And then you start adding in Russia, South Africa, Brazil, and Mexico, right? So when you look at the Southeast Asia region, first of all, it's home to 4.5 billion people. So it's probably the biggest trading bloc to date. Secondly, the demographics are very young, so that facilitates a lot of infrastructure build out, consumption, technology innovations, all of those taking place. And when we look at the difference between emerging markets and emerging Asia, what you're leaving out is essentially commodity producers. So Russia, South Africa, Mexico, Brazil. So our tilt today is a little bit more towards emerging Asia rather than the broad-based emerging markets per se.
So then it would be a good pair to take some commodities since you're losing that exposure if you have emerging Asia and pair those with that fund.
Exactly.
Yeah, that's what I was going to say, Aaron, as well. You capture at least 80% of the emerging market economies by emerging Asia, and that's where we're seeing some of the fastest growth out
there. I had a question from a few slides ago about, we've done a lot of talking about emerging markets and small cap, but you also said you're seeing a lot of innovation still out of some of the mega caps. You mentioned Microsoft and Amazon. So I was just curious what your position is on some of the mega cap exposure that was the leadership of 2020.
So as I said, it all comes down to stock picking. So where we do see exaggerated valuations, which don't make sense. So let's say there's a company XYZ, trades at a very high valuation. It's already discounted 5 years of growth. Should I be holding that at this point in time? Not really, because all the growth that I expect is already in the price. So we would be trimming that and actually looking at the cyclical universe where valuations are cheaper. Now, that again, as I mentioned, is a stock by stock case. I wouldn't broaden it to say that's only in technology or anything of that sort. So technology by itself is a very vast universe today. Literally, you can break it up into half a dozen different subsectors. So semiconductors, software, social media, cloud computing, automation, those are all very different areas within technology per se today.
And Nash, one of the things I think is on everyone's mind that is watching this is, isn't the market overvalued? And we've been talking about earnings, and the earnings surprise that are coming out, I think is 68% of the companies have reported, 86% of them have beat expectations in aggregate by 15% or greater. Being that you guys are overweight equities versus fixed income, what's Fidelity's take on the valuation of the market today?
So, yes, the equity valuation, which is in the U.S., definitely on the higher side of things. So one has to be careful of what you're buying. So we are broadly not buying everything across the market. So stock picking is a key distinction today. And secondly, as I mentioned, valuations outside the U.S., more so in developed markets, which is nothing but Europe, Japan, Australia, Canada, and emerging markets are cheaper from that perspective. So when we say increase allocation to equities, what we are seeing is in the domestic market, buy the neglected cyclical sectors, and then increase your allocation to international and emerging markets.
Hey, Nash, we've talked a lot about the things we're optimistic on today. What are your thoughts just as we look throughout the year? There's probably going to be a lot of political noise out there. What are you, in your view, what are you bearish on, and what are some of the biggest risks you see throughout 2021?
So the one thing I would say is that the key risk sitting today is probably inflation going to the higher side of things. And that's just not a U.S. phenomena, could be a global phenomena. And we've seen in the past that especially food or energy inflation could lead to social unrest. So I think that's the consequence of it. So that's one risk that I would be watching out for. Secondly, as we always say, the Middle East is one of the biggest unstable regions of the world. So could there be some risk coming from there? That's always a possibility. And sitting today in the U.S., the consensus is that with the blue sweep, everything will pass. Maybe there are some moderate Democrats who may start putting a few hurdles in the way, so not everything may pass. So those would be on the political side of things in a sense.
Nash, one of the things that we have heard for quite some time is passive, passive, passive. And you've been talking about stock picking. And I know it's a softball to talk about, asking Fidelity to talk about active picking, but last week GameStop was everything that everyone was talking about. And we had mentioned on the Spider ETF for retail XRT on how large of a position GameStop became in that index. Do you think a lot of these inefficiencies and a lot of the market being tracking these passive, that there's some risk to the idea of passive investing?
I would say there is a significant amount of risk in passive investing, not just from a market structure perspective, but also more so from a performance perspective. And let me give you one statistic that we commonly cite. So most people think about stock picking is all about picking winners. Not really. If every year you were able to pick the bottom 50 stocks within the S&P 500, which is to say you could identify the worst performing stocks and to avoid them, you would outperform the S&P 500 by 400 basis points per annum, or 4 percentage points per annum. So I think it's equally important to understand who's just not the winner, but who's likely also to be a very big loser. And that's what passive investing misses out on both the sides in terms of it buys everything which is out there. And as we say, you get what you pay for in a sense. So if you want outperformance, you have to pay for it via active investing. And yes, you have to look at things on a net cost basis. So is the manager actually giving? All right. So I was saying that one needs to look at passive versus active by looking at the underlying cost and also how much outperformance is the manager actually providing.
Aaron, I would also add to that, we've done a lot of studies at Fidelity around active and passive investing. And one thing we found is out of the entire industry, there are north of 300 mutual fund companies in the industry, thousands of mutual funds. Over 90% of the assets are in the top 50 fund companies in the industry. 50% of the assets in the industry are in the top 5. Fidelity, thankfully, has been in that top 5 for 25 years going, if not longer than that. Not that we're perfect in every capacity, but the larger firms that generally have a lot more resources can flip over more rocks at a much better price point. I think oftentimes the industry looks at the active space and says, well, the average fund maybe cannot outperform the index. And if you look at those 300 fund companies, there are a lot of funds that, you're right, can't outperform the index. But I think if you're looking at the top 50 asset managers, which if I think about your portfolios, most likely you're using those top 50 asset managers in some way, shape, or form. That's generally where you see a lot more scale, a lot more resources, and performance that's over and above the index in many cases.
Yeah, our solution is just not buying average funds. Now, the hard part is trying to figure out which ones are and are not average.
Right.
We appreciate everyone listening and tuning in. And please join us next week whenever we cover another Market Insight call. Likely to be here. I don't know that next week is when Chris is going to take over. I know my wife would appreciate it if that's the case. But just click below and subscribe. And if you have any questions, feel free to reach out to your lead advisor. We're here to help. And we appreciate your time. Nash, David, thank you.